Hello, welcome back. We're going to examine a company that has really spiked my interest lately, and I'm not the only one. I'm looking around and I'm seeing more and more people actually talking about it. And it's Lockheed Martin, an aerospace and defense company, which has quite a few contracts with the US government, I believe. So I wanted to examine this one because I'm seeing that it has like a forward P of 17.3 as you can see here. And it has been growing in value, so it hasn't really been doing bad at all. It's actually doing really well. And it's coming off of a double bottom, by the way, in case you are a little bit technical here. But notice the performance returns here, almost 20% up in a month, 40% in a year. Now, most people will look at this and be like, this is awesome. I kind of prefer it when it's kind of red a little bit, just because I can get a better price for my money. And regardless of that, though, we want to examine what the company is doing financially, because if it's doing well, it doesn't really matter what the price is, and if it's cheap, again, it doesn't matter what the current price of the stock is. It's just a little bit better to have a margin of safety, regardless. Now, the first thing that we always want to examine is very important is the outstanding shares, and this is something that I really liked seeing here. This is amazing. Look at that. The company had like 320 million shares over here, and now it's down to 273 in about what, like 7 to 8 years. So they have really reduced their outstanding shares here. And so if you were holding shares at any level over here, you actually got an appreciation of your stock just from the float, just from the outstanding shares going down in volume. And so your shares are actually worth more now. So I hope they continue this part, and that's going to be awesome for investors. Now, we're going to move on and examine the financials of the company, and as usual, we're going to have a full-blown discounted cash flow model that we're going to be looking at the very end, so stay tuned. And if you're new here, welcome aboard. I'd ask you to smash the like button, as most YouTubers say, because that really helps the channel grow and helps me make more videos, and then I can help you make better investments, and it's a win-win, so why not do it? It's totally free. And if you are not a subscriber, you may want to become one, because there's a lot more videos coming out soon, and also an application that I'm creating, an exclusive application for the subscribers of the channel, so stay tuned. Now, the total revenues of the company have been increasing, and increasing very nicely from 2017 till today. The company has gone from 50 billion here to 67. That's a very steep increase here, very nice. And you wouldn't expect that necessarily from an aerospace company. You would expect much steadier. But they are still growing. That's nice. And the net income of the company here is also increasing rapidly from 2 billion to 6.3. That's absolutely awesome in 4 years' time. Company is really increasing its bottom line here. What about the balance sheet? How is that looking like? Because these types of companies tend to have a lot of debt. What's going on here? The total liabilities of the company are sitting at 40 billion. That's a lot of liabilities. But the total equity is sitting at 11 billion. So as you would expect, they have way more liabilities than total equity. And you may come to expect that just because there's a lot of leverage when you're creating aerospace and aerospace equipment, I guess, and planes and all that. So you would kind of expect that from a company of that sort. Yet it's probably a little bit too much. Like total liabilities of 40 billion and total equity of 11 here. That's a steep difference here. So I'd like them to actually bring that down a little bit if possible. What about the cash flow of the company? The cash from operations is also increasing from 6.5 billion to 9.2 billion, which is also pretty great. Company is really increasing its cash from operations here, and they are investing in capital expenditures for the most part, so not much going on in terms of other types of investing here. What about the financing? I'm assuming actually they are net repaying debt. Actually, they are for the most part repaying debt, not really getting new debt here. So, okay, that's good. So they are repurchasing common stock, as we have seen earlier, 4 billion in 2021. They really repurchased stock here. And they are paying a little bit of dividends, which we're going to examine here. Free cash flow from 5.2 billion this wasn't a great year over here, but then 5.8, 6.4, 7.6. I'm wondering whether this has to do with contracts, because I'm assuming this kind of companies tend to fulfill a lot of contracts, so they may have some years that are not great and then other ones that are really great. But now they are sitting at 7.7 billion from 5.2 4 years ago. That's pretty nice. Very, very nice. I want to examine the dividend too for the company. So I'm gonna go to the dividend tab here, and you will see that the payout ratio is sitting at 47% here. And even better, the company is steadily paying dividends here, as you can see, and steadily increasing dividends. So they haven't really decreased dividends or cut dividends at any point, which is really nice to see. And their payout ratio is relatively healthy. I mean, it's 47%. It's healthy. I mean, anything below 50 is probably fine. So I'm happy to see that. I think they will be able to fulfill their dividend for a long time to come. Okay. So the next thing that we're going to examine, and I want to take a look at, is the solvency here, just because the company had quite some debt, as you can see. It's increasing, but decreasing from previous years. So it's actually they're managing debt better than before. Oh, that's interesting. I would expect it to be higher than ever, but actually it used to be even higher. Okay, so that's good then. Profitability, 75% return on equity. I actually haven't seen that before. When I was examining the company, I forgot to take a look at the profitability tab, but I'm seeing it now. That's insane. They are getting insane return on their equity here. Wow, that's really, really good over here. Now I'm going to take a look at the free cash flow model that I have created, and I have already pasted the free cash flow values here for the 5 years and the outstanding shares in million, which are sitting at 273 million. We're going to use a discount rate of 13%, which is like the usual that we're using. And you will see that the 5-year average free cash flow growth of the company has been 44% here, but it's mostly skewed because of this value. I think I'm going to go to something towards like 8 to 10%. I think I'm going to use maybe 8% is fair here. And the perpetual growth rate, 2%. Either 1 or 2% is probably fair. And I'm getting a price per share to pay today of $387. And the company is currently sitting at 456, so it's pretty close to where we would want it to be for purchasing the company. And I think if you give it a free cash flow growth of 10%, which is also possible, yeah, you're arriving at basically today's value, very close to it, $443 over here. So, or even if you discount it a little bit less, like 12%, then you're surpassing that, and you'll be good to go with these values over here. So I kind of like this company. I mean, I like what I'm saying. I obviously would like to get it at a better price, like 400 maybe, if possible, if it goes down, or 380, as we saw earlier. But it has been doing very, very well. Now, the thing that kind of is unclear for me is what's going to be happening in terms of growth for the next years for this company, just because they have been growing a lot. And if you examine the cash flow again, you will see that they made 7.7 billion in free cash flow, and that actually helps a lot with total liabilities as well, because they had like 40 billion, which means that they can use like almost 6 years of free cash flow to pay everything if they want to, which is fine. But the problem that I'm having here, and it's not really a problem, but it's an unknown really, I don't know what they're going to be doing in terms of growth in the next few years. Can they actually sustain this kind of 7.7 billion free cash flow? Because it grew steeply from 2019, so it grew very well in these past 3 years. I don't know if they will be able to sustain that, but if they can, then we are looking at a company that's potentially going to grow a lot in the next few years. So I like what I'm saying, and they do have a pretty safe dividend as well, and their dividend was like 2 point something. What was it? 2.45%. So it's pretty healthy as well. So while holding the company, you could be making some extra money on the side. I like that. So overall, I like what I'm seeing with this company. I think it's an interesting purchase here. And you may want again to shortlist this one as some others that we have talked about in the past, because it has been a high flyer lately, and you probably don't want to get it when it's high. But if it goes down to these levels, I am buying here. I mean, I really like it at these levels, like 335. And it was here 3 months ago, so 4 months ago. So, you could have entered there, or it may actually revisit this level. It has actually visited this level twice already, and it went back to 400 and then down to 340 here. So why not happen again? It could happen again. So hopefully that gives you some ideas about Lockheed Martin. I think it's worth examining. I mean, it looks like a fairly interesting company to me, and it may prove to be an interesting addition to portfolio. So if you enjoyed this video, please leave a like and again subscribe or join our Discord channel. You can find a link in the description box below. And in the meantime, take a look at this video that I made earlier. It's about Baidu, the Google of China. And we're examining whether it's a nice potential purchase here at this current price. Thank you for watching this one. See you in the next one. Bye bye.